Okay, so finally, or maybe not so finally, I might do a few more modified internal rate of return. But we get to one of the big ones outside of NPV, which is internal rate of return. And what we do with internal rate of return is we're basically setting our initial outlay to zero. So try to understand that. We have our free cash flows. We're dividing it by the internal rate of return. By dividing it by 1 plus the internal rate of return and raising it to the power of each cash flow, n being whenever these cash flows occur, so this would be year 1, year 2, up to year n, we're going to get, and starting with the initial outlay, what we're going to get is we're going to be solving for IRR. So to be, let's look at this formula. What we're really doing is we're finding our cash flows on a present value basis minus my initial investment, and I'm solving for the rate of return that would set those cash flows to zero. So effectively, I'm solving for the return of the investment. Again, we have cash flows, we have an outlay. If I solve for the proper rate of return that will discount those cash flows, where we have exactly zero between the outlay and the discounted cash flows, we're going to get a return on our investment. So you could do this again in Excel by using the IRR function and just this time incorporating the outlays and the cash flows, as opposed to NPV where we just incorporated the cash flows and subtracted the outlay. Here I left that up there for you to remember or for you to review. Now we've done this where we have all of these. So, back in the day, you had to extrapolate and go back and forth until you came up with the right rate of return. You had to keep, just keep plugging numbers in. But with the magic of the PC and Excel, now you could just use the internal rate of return function, which is my preferred method, even though you could use any of the business calculators and it'll do the same thing for you. You just set this, all you really need to do is plug, scan down all of your outlays and your cash flows. And effectively, what this is telling us is the return on this investment would be 13.127. Would be 13.127, depending on the cash flows. If I was to make the outlay a bigger number, notice that the IRR would now drop to 4.47% because I had to lay out more money. If I was to make this a smaller number, we would have a much higher rate of return. So that's what IRR does for us. It tells us the rate of return on our investment once we've inputted the outlays and the cash flows. You notice with this graph that with the higher rates, higher discount rates, eventually with a low discount rate, we're getting a much higher net present value. But once we hit that zero coordinate, that would be our internal rate of return because there's no return. So with 13%, we have no return, and effectively that tells us that 13% is our internal rate of return. Obviously, with lower rates of return, we're going to have much higher net present values, and we're going to be profitable. At higher discount rates, we're going to be losing money and in zero. But right when we hit that x-axis where we are set to zero, that's how we mathematically find the internal rate of return. The problem with the internal rate of return, the good news with the internal rate of return is business people love it because it gives us a percentage. You can make 20% on this investment. You can make 15% on this investment. Easy to understand. Great for explaining the bottom line. The only negative, and this is really important that you remember this, is that traditionally, almost always, we have in a project or in an investment, we lay money out and we get positive cash flows. However, if any of these cash flows turn negative in between, like say for instance, cash flow 3 is a negative, or cash flow 2 is a negative, you can get conflicting numbers with the internal rate of return, in which case you'd have to use a modified internal rate of return, which I'm not in love with because it's like kind of knocking a square peg into a round hole. It's just you're kind of like blending years. And again, I'm not a big fan of MIRR. I probably will do a video on it at one point, but this is what you need to know. IRR is always one of the most acceptable methodologies used by CFOs and by CEOs and by investors. But if you have a weird or an unusual, I should say, negative cash flow somewhere in your cash flow schedule, you're going to have a problem with IRR. So be aware of that. And that kind of wraps up part 5 of the cash budgeting review that we're doing.